Welcome to the Weekly Social, folks. Everything Katy, Fulshear, Richmond, Texas. We have David Berenger, Auto Mortgage First Choice. Thank you, David, for coming today. And we also have the lovely Missy.
Oh, with Redline Realty.
Yes, she's a new addition to our team. So, formal introduction, Missy Yee has joined the Redline Realty team. So thanks, Missy.
You're welcome.
So tell us a little bit about yourself, David.
Thank you, Richard. Good morning, everyone. Good morning, Missy.
Good morning.
Thank you for having me and for setting this up. So I'm David Berenger. David, you're a mortgage pro, if you wish. I tried calling myself an expert in marketing materials a few years back and was told that could get me in trouble. So let's keep it modest.
Yes.
Well, in the
Let's
lending
stay humble.
industry, they're very specific about the words you're allowed to use in marketing, aren't they?
Yes,
Yeah.
yes, indeed. And I can come back to that. But later on, you have to be humble. You have to stay abreast of changes.
Yes.
You have to think about how to communicate, how to position yourself to the right demographics, to address people's needs, stay current on what's happening in the world. So of course now the concern is about interest rates, but there's more to it than that, clearly.
You've carved out a very niche market. And I've known you for years. We met
Right.
at a networking event, if my memory serves me correct.
Yes, your Katy net worth.
Yeah.
Yep.
Oh.
One of the most productive networking events for me to attend over the last few years. Quite sincerely. Oh yes.
Yep, I've
So-
seen you.
Third Thursday of every month at Gauchos.
5:30 to 7:30.
Right.
If you're a
That's
community leader, professional, or local entrepreneur, business owner, come on down.
So even though I live a bit up north from here, I hop on the Grand Parkway. I brave late afternoon traffic, and I try to be there as often as possible. Yes.
Oh, yay.
Yeah.
Okay.
So a niche market, perhaps. Yes.
Yeah.
Yeah.
Actually, you helped with a client of mine not long ago.
That's right.
So there was a little bit of difficulty there, but
I'll remember it well.
you came up with the solution to help guide and get her through the process. So thank you.
Get her through the process, and basically now I have to say I have to avoid the details, right, for confidentiality reasons always. And it gets very personal. The mortgage business gets very personal, right?
Sure.
It gets up close and personal with people's finances, and which are often people's most intimate secrets, if you will. And so
Sure.
Yeah.
it's not a job for the faint of heart. You've got to be careful there too. But yes, I actually saved a lady's home from foreclosure and allowed her to remain in it using a reverse mortgage, or the legal term is the home equity conversion mortgage.
Home equity conversion mortgage.
Right.
Okay, I just learned something new today.
Or HECM. Or HECM.
Okay.
And when I did this well, yes, when I teach a class on this, as you know,
Okay.
right? 2-hour CE, continuing education, two CE credit hours for participating realtors who want the credit. It doesn't have to be for credit. It doesn't even have to be a class. It can be a presentation for seniors 62 and better. We don't say the O word.
62 and better.
And better.
Yeah.
Exactly.
I like that.
Right. It can be a lunch and learn. It can be a presentation at a community event, in a church, at a Rotary Club. Anywhere, any venue where I can get an age qualified, or mostly age qualified, and interested audience.
Sure.
I welcome the opportunity, and there are different ways that. And I'll begin by asking, what the heck is a HECM? Well, HECM stands for Home Equity Conversion Mortgage. It's the FHA-backed and thus government-sponsored reverse mortgage program.
So it is an FHA.
Yes. So it's not the only.
Is it a conforming loan?
So no, a conforming loan, conforming and conventional, that gets a little confusing. Conforming or conventional loans are for purchases, pretty much for purchases only, or to refinance into.
Okay. Yes.
They're what we call in the business forward mortgages, meaning that they're funded the full amount up front. The full loan amount is funded by the lender up front at closing, and then the borrower makes fixed monthly payments.
And buys down or pays.
Pays down the
Principal.
balance.
Principal.
Pays down the balance.
Correct. Yeah.
So the
Correct.
informal name, so the home equity conversion mortgage is not the only reverse mortgage program out there. There are others that are called proprietary, which means lenders keep them on their books as opposed to selling them
I see.
in the market.
So it doesn't go to the open market.
They don't go to the open market. So most loans both forward and reverse in today's world, especially since the mortgage market was sort of reorganized after the 2008-2009 financial crisis.
Yes.
As it should have been.
Yeah.
As it should have been, and I'll add a quick background on that in a minute. Yes. But so most loans that are made that are conforming, meaning or conventional, and then the other main programs are FHA, typically FHA forward loans, purchase loans, typically for borrowers who don't have such good credit or who don't have as much for a down payment. They can buy those. That allows them to buy with as little as 3.5% down the purchase price. And that can be gifted by a family member, let's say. It cannot be borrowed, but it can be gifted, right? For example, and so then the VA loans, Veterans Administration loans for our veterans and active duty service members and their families, and so that also is how our government thanks our servicemen and women for their service and helps them usually with no money down at all, right?
USDA 100% financing, you're correct.
Yeah, 100% financing. It's even possible to assume a low rate VA loan for one veteran who qualifies to assume, meaning take over the payments on an existing low rate VA loan at a rate that's not obtainable today, if they're able to pay the difference in cash.
In the equity.
They have to buy out the seller's equity.
So can a non-veteran assume a VA loan?
Usually not.
Okay.
In some
It
cases,
does have to be another VA.
in some cases, but it's the preference of the VA and it's the political will and will to really reserve that program for veterans and their survivors and families. Well, veterans, but also active duty service members, right? But really, it's to help them, right? And but also protect them. VA allows no money down. It can also allow the highest debt to income ratios, or they don't even use what we call DTI. Typically the same way. They apply a residual income, meaning that you have to have enough left over, depending on your family size, to pay your non-mortgage bills right at the end of each month.
So you can have a slightly higher debt to income ratio than a traditional conventional may require.
Yes, definitely. So that DTI ratio typically tops out at 45 to 50%. For a conventional loan, it can go as high as about 55% for an FHA loan. It can go, we've seen some go into the 60s.
Oh my
right,
God.
for VA.
Yeah.
Yes. If the veteran's residual income is high enough. And another reason for that is also the way those can get interesting as well, is that many veterans, if they have a service-connected disability, can get breaks on their property taxes.
Oh yeah, huge.
Yes, well, huge if you're rated 100%.
Correct.
If you're 100% disabled, you basically pay no property taxes.
Correct.
Right?
Yeah.
So I have some neighbors in my neighborhood, for example, who are not paying the mud tax, right? The municipal utility district.
Mud and school taxes, the two high ones in our market.
Yes, 100%. So veterans have the best deal, especially.
There we go, guys.
We're also subject to
Now you know we're live, so
Okay.
sorry about that.
What's fine? What's fine? All right. So,
Mom, Richard will call you back later.
Yeah.
So veterans are heavily protected and favored, and we want to have them in home ownership and keep them in home ownership and protect them from mold or from humidity or conditions conducive there too, and for them to get in trouble.
Sure.
Essentially, what happened to the mortgage industry, essentially what happened in the early 2000s, so a little over 20 years ago, is there was sort of an economic slowdown, bit of an economic slump post 9/11, overseas wars and everything. The country wasn't too happy, and the Federal Reserve chairman at the time, Alan Greenspan, who had been chairman for decades before, remained chairman for decades, right, and who had lived through other times and so forth, and he was a little bit frustrated that the home ownership rate in the U.S. was stuck at about 64%, and it's still about the same today, unfortunately, or fortunately or unfortunately. And so his thinking and members of Congress agreed with him and other authorities. Well, let's loosen things up a little bit. Okay, let's let Wall Street do its magic, right? Let's let the financial markets do their thing. Let's open up access to home ownership to more Americans. Let's try to raise that. And so loose lending, subprime. All right, and it looks great. And yes, by late 2007, early 2008, and I looked this from the other side in the asset management business at that time. I wasn't a loan officer then.
Oh, okay.
Yes, I didn't grow up in this business.
We do have to touch on
Yeah.
David's background actually before he started doing
Oh,
what
geez.
he's
Where do I start?
He comes from a professional expert background on numbers.
Oh, he's not in the witness protection program? No, yeah.
Well,
That's what's in his folder said to say.
I lived overseas for a while too, and so I guess people might wonder, well, was it CIA?
Yeah.
No, they don't pay enough. No,
No.
I wanted to make money, right?
Have you
Like,
seen what they draw?
And not risk your life.
Yeah.
and not risk my life.
Yes.
Now, not that many.
Hats off to those guys, by the way.
Not that many people will try to kill you if you can't get them the mortgage they want. They might be upset.
Yeah.
The referring realtor will be even more upset if I don't do my due diligence up front and look into those property taxes, the true cost of homeowners insurance.
If the deal derails.
Right. Nobody wants to waste time
No.
and lose face on a deal that derails. And it's all too easy for the millennial generation, right? The millennials, Gen Z, starting to enter the real estate market, right? And they're right to want to pursue home ownership, of course, but they think they know it all thanks to the internet, right?
I know.
Anyone could go online, find some calculator that allows you to, you think, okay, my credit score is about this. They're probably overestimating that too. They're probably a little too optimistic there too, but they think, all right, if this is my credit score, this is the interest rate that I should qualify for, this is the home price, and this is the down payment I have. So they have some of the variables that they'll need.
A general understanding.
They have a general understanding, but what they don't understand is that typically their principal and interest is going to be only about 60% of the overall mortgage payment. In some cases, even less. It's PITI, principal, interest, taxes, and insurance.
Correct.
And
HOA.
without even mentioning HOA dues, very
Flood
often,
insurance.
increasingly.
There's a
Yes.
lot of moving. There's a lot of moving pieces to this.
Oh yes, of course. And lenders are becoming more aware. So lenders go by the FEMA flood maps, Federal Emergency Management Association. Problem is those go back to the 1970s.
Well, and they change all the time too.
Yes, and even if they change slowly, right? Government bureaucracies move slowly. Even before Trump came back and Elon Musk joined him, and even before, even if it's one of the agencies targeted for cutbacks, the realization is sinking in, right?
Well, as you build up neighborhoods in drainage retention, all that changes and it shifts the landscape.
Oh, yes.
So the FEMA maps have to adjust to that.
Oh, yeah.
With the growth in the changing of the landscape.
And even if the FEMA maps are not updated yet, it's not that hard for either lenders or insurers to understand. I mean, we're in Katy, right? The Katy Prairie starts north of us and goes up the 290 corridor. What was that before it became
flooded
rice
fields?
Well, and not
That's what
even
I thought.
that. Richard and I, when we were driving through some neighborhoods, we were pointing out because he's been in this area for at least, how long would you say, Richard, in the Katy area?
20 plus years.
About 20 plus years.
Mm-hmm.
And I've been in the Houston area in general for about 25 years. And what I have noticed is certain neighborhoods, once they start construction on that building, a 2-block building, it affects the water. Every time it rains, it floods in that area. And so neighborhoods are constantly being affected. They may not have flooded last year, but they're building a memory care facility here now, and all of a sudden that is now causing flooding in their neighborhood.
Right.
Yeah.
And even if the flood risk is low for a given house, right? Insurers are losing so much money in other parts of the state or other states, right?
Sure.
And I mean, Texas has its share or more than its share of natural disasters, right? Now, I'm not an insurance agent, right? Full disclosure, right? But I'm involved in that part of it often enough, and having to give my borrowers, right, your buyers, the bad news sometimes of no, that insurance is going to cost more than you think, and yet it's going to be mandatory. Maybe the lender will require flood insurance, right?
Well, and it also goes to the property station of insurance because they have what they call the clue report. So the property might be good, but there was a major insurance claim a year ago,
right,
where they spent a bunch of money fixing something that was fire, roof, or wind, hail, or whatever. And that's something that's unbeknownst to the general public
Right.
until you pull that report from the insurance.
Well, yes, sure. So I mean, so we pull credit reports in the mortgage business, and that's where we find out more than we ever really wanted to know about people's lives. Right? You look at someone's credit report, like I said, like the 3 Chinese monkeys. Right? I like one of them, right?
Oh, and
I
then
have to see everything. I have to hear everything, but
Yeah.
oh.
you do not want to know what I've seen on people's credit reports. Something that they may themselves have forgotten about or want to forget about, right? And then you see what their bank statements as well, which we have to ask for to make sure that they have
Everything's in alignment, right?
Everything's there. You know,
Right.
everything's there. What they're spending their money on. You know, a psychologist would have a field day. It's, no question. But the real problem is insurance is becoming way more expensive. Property taxes are high and rising as well because
assessed values are rising, and that drags up our property taxes.
Right.
Yes,
The rates
yes.
have stayed the same,
Right.
but the assessed values are going up.
The tax rates can actually go down. The homestead exemption, I believe, is set to go up again, right? If it's the Texas legislature.
And they're supposed to cap it too, to where instead of it going up 10% a year, I think it's supposed to come down to only go 5% a year, from what I read.
I've heard that too.
We need that.
I could benefit from that personally, especially given that I'm not a veteran. I have 0 disability ratings. I'm also not 65 yet. I cannot freeze my property taxes where they're at. I qualify only for homestead.
Me too.
Yeah.
So yeah, exactly. So and still for some years to come. I'm not quite yet a senior helping seniors. Although I'm looking forward to reaching that point and continue to. And being a loan originator is great in the sense that you have flexibility. So I have to bite my tongue. I have to keep a lot of people's secrets safe. I have to be very understanding. Have to navigate delicately sometimes, but
there's a lot of confidentiality that we all work with.
Yes,
in this industry.
absolutely. I mean, it's life events that drive real estate transactions very often more than interest rates.
Yes.
And so you also have to understand the family dynamics behind what's happening, right?
Oh yeah.
But so maybe if we can spend a few minutes on the seniors question,
Sure.
right? Because
Perfect.
yes, so a number of things, right? A couple of things that struck me when I got into the lending business, right? When I became a loan officer, only in 2020, right after a 25-year career in asset management, is a number of people seem to believe, aside from how lending standards have been tightened following the disaster. So subprime that I mentioned earlier ended in disaster, almost crashed the world economy as much as COVID, but for much longer. Mm-hmm. And so basically the powers that be decided, well, we're not going to let anyone buy more house than they can afford, and they can really afford, right? Mm-hmm. They left a few loopholes, however, that are pretty glaring.
Consumer Financial Protection Bureau came out.
Exactly. That's right. And it's still there, and it's still part of the loan disclosures that you need to send to anyone, including on reverse mortgages, all your protections, who to call if you feel that you were given bad advice, and so on and so forth. So a lot of regulation in a good way. But also, I felt like a lot of people in the lending industry believe that our only purpose is to help young families achieve the American dream of home ownership. And yes, of course.
That's a common.
Yes,
it's a common theme.
It is a common theme, and it is part of our purpose, absolutely. And it's a great thing. And I even have written up a presentation about building wealth through home ownership, right? And why, to the young people who think they can't afford to buy a house, I'll tell them you really can't afford not to, in terms of where you're going to be when you're my age, right? You're going to need that home equity.
That's right.
And
that is your path to wealth.
It is a path to wealth. I mean, unless you have Microsoft stock options, and even then,
you bought in the 80s,
right? For example, even Apple stock apparently is tanking today now that they're being told make
You're fighting in the U.S.
or face tariffs.
Yes,
right?
exactly.
Now, whether that really happens or not, who knows? But the point is, it's volatile, right? And the real estate market can be too. But yes, you need that. You need that home ownership. You need that wealth for home ownership, and it gives you more options later in life, right? And that's the point. And that's my point, and that's why. So partly to diversify my business, partly out of a personal interest, if you will, as I could see, when we moved to Texas, bought our house, beautiful new house that we had semi-custom designed, had built.
Good for you.
Yeah, exactly. I mean, I'm happily enjoying a house that I could not have afforded to build on Long Island in New York, let's say, or in Connecticut, and I wouldn't even want to. I mean, like, I wouldn't even, you'd have to first buy a lot with an old teardown on it for about $1.5 million
For the lot.
for the lot.
Yeah,
You're basically buying the lot. You're basically buying the lot. Then get a permit from the city to tear down that old house that's sitting on it. And of course, all the neighbors are going to furiously lobby against that because the big mansion that I would build is going to make their houses look like, well, you know, less desirable.
right.
Okay, so, and then that's before you even start building.
Oh, good.
And then let's not even talk
It's
about
very
property
cost
taxes.
prohibitive.
Yes, exactly. It's cost prohibitive. People think our property taxes are bad. They should try New York or New Jersey.
Yeah.
Because we kind of skimmed over that part,
Yeah.
but David comes from a 25-year asset management career,
Yes.
originally from the East Coast, as well as 20, 30 years in Europe.
Well, not they overlap.
Overlap, yes.
Crisscross.
Crisscross. Well, so initially in New York, yes, starting in the 90s, working in operations, mutual fund companies, and so forth, and transitioning to a marketing role, and then becoming a European business development director, head of the European market for some New York-based asset managers.
Oh, wow.
And so, yes, and so.
So when you're talking about some of the trends that you've seen out on the East Coast and things like that, you lived through it. You experienced
through
it. It's not stuff
I
that you
lived through
read
it, and I made,
academically. Yeah.
I made a, I think, somewhat well-informed decision not to return to live on the East Coast. And I joked people who asked, well, why did you move to Texas? And I call myself a refugee from the brutal winters and the high taxes on the East Coast.
Yeah.
The truth is I can handle cold weather.
Yeah.
I don't love it.
Yeah.
You just can't handle high
It's not.
taxes.
I don't like high taxes. I believe in my freedom as an American to move within this vast country.
Yes.
Okay, that's literally, you know, the third largest in the world, right? And most of it's still wide open and just so much more dynamic in some places than others. You know, again, my neighbors complain about the property taxes. They're vowing to be out of the neighborhood the minute their last child graduates from high school. We'll see where they end up going, right? But whatever the case may be, they have no idea what really bad taxes added to economic stagnation really look and feel like.
And we don't have a state income tax down here either.
Exactly. No, that helps a lot. And yet, all of that notwithstanding, I could see my property taxes, my own property taxes and insurance costs, and HOA of course never goes away, and repairs will be needed down the road, even to the best built house. And I could see that, you know, going from $20,000 a year today, let's say, to $30,000 plus 10 or 15 years from now. And I thought to myself, well, of course, the obvious answer is to downsize, right? Okay, but what if I don't want to? I have a bit of a contrarian spirit about myself early on.
You're immortal?
No, that I'm not. That definitely not.
You're not gonna live forever?
Forever is a long time.
Yeah.
He'll admit
I don't think I
to the
want
fact that
to.
he's contrary at times.
What I like to say is, I'll decide when I'm ready to move.
Yeah.
I do not like the idea that I'm going to be forced out by my property taxes or the increasing cost of my homeowner's insurance, et cetera. It's like,
But that's why you see neighborhoods cycle 25 years,
right.
typically. Because once you get to a fixed income, it becomes a challenge keeping up with everything.
That's the point.
Right,
That's
because
the
your
point.
income is fixed, but your expenses are not fixed.
Right,
unfortunately.
right.
Yeah.
So that's exactly, and that's a perfect segue into reverse mortgages. So and so I asked myself. So my personal interest was, okay, it was a term I had heard without really knowing what it was.
Reverse
how it
mortgage,
worked.
right.
Yes, exactly. But I thought, well, I think I'm capable of understanding the math behind it. You know, the term it's actually not that complicated in most cases.
Yeah.
The term reverse mortgage comes from how the first ones were set up so that payments flowed from the lender to the borrower. So in reverse from how it typically is when you or I take a mortgage out to buy a house and make payments, right, to pay down the loan balance. In this case, in a reverse mortgage, in most cases, it's payments to the borrower or a lump sum up front, and then in either case, interest accrues on it. So that balance grows. So it's a lien on the property the same way, right? It needs to be repaid at some future time, but it's not payments that the borrower has to make ever, and that's the key point. Okay, and so I started asking myself, well, if my property taxes are going to go up because my home value is going up, exactly to Richard's point, these seniors who are feeling priced out, they wouldn't be if their taxes were the same as what they were 20 years ago when they bought the house. The taxes have tripled, let's say, the tax amounts,
Sure.
and thus, and some, at least in my neighborhood, some of my neighbors, based on the discussions we have, they actually don't seem to realize that even when they pay off their mortgage, the mortgage in the last few years of a forward mortgage is basically
very minimal.
It's basically just principal. You're basically paying out principal. Yes, most of your payment is actually taxes and insurance if you escrow.
Correct.
And most still do. I mean, even seniors no longer who have built up enough equity.
I escrow.
Well,
It's a safety net, in my opinion.
Yeah.
exactly.
Yeah.
Exactly. Otherwise, you have to apply more self-discipline. You have to
Sure.
put aside. You have to privately save. For those payments at the end of the year. So yes.
And for people who may have not gone through the home purchasing process, or it's been a really long time, escrow is a specialized account that you pay into every month, and it is meant to pay property taxes and insurance. HOA at times, or
HOA is typically separate.
separate?
Yes,
Okay.
usually not.
So property
Yeah.
taxes and insurance, just so you don't find yourself at the end of the year or whenever the taxes are due, going
Well, it's January 1. It's right after Christmas.
in the
Right.
spirit of New Year's.
Right.
Yes.
Yeah.
Right.
Yeah.
Yes, that's what escrow is, and so it's required of buyers who put less than 20% down.
When they purchase the home.
when they
for
purchase the home,
financing.
exactly.
Yeah.
It's optional if you're putting down 20% or more with most loan programs, or you can ask to opt out of it later on, right? However, it typically comes with a trade-off of slightly higher rates, right? And if you do it up front, and here's the reason: with the mortgage servicing companies that collect those payments, they collect interest on that portion of it all year long, and they can invest the money. So servicing rights to a mortgage have value. The public doesn't realize, but usually most mortgages are split off right before they sold. They're split into the actual underlying note, which gets bundled up with many others by Fannie Mae and Freddie Mac. That's the aftermarket, with at least the first stage. Secondary market, yes, a secondary market, and then but then there's often a third stage, which is they securitize, meaning bundle up 1,000 mortgages, let's say, of comparable rate and risk characteristics, and then they bundle those into a security that can be sold, then a bond series that can be sold to a pension fund. So the beneficial owner of your mortgage today could be the city of Chicago, Guns and Hoses, or Police and Fire, right? Pension fund.
Right.
It could be a Swiss pension fund.
Yeah.
You just don't know, right?
Because it's sold through Wall Street.
It's sold through Wall Street, exactly. That's where Wall Street comes in, right? And lost control at one time, and so they're much more tightly supervised now. But I just came back to this idea of, I don't like the idea. Of course, at some point, I not only won't live forever, I won't be in as good as physical shape or in good health forever necessarily. I mean, the cycle of life. Let's all be realistic.
Yes.
Let's all be realistic. So being in my 50s gives me a front row window into that, if you will. Just looking at my 85-year-old mother and my 88-year-old mother-in-law, both widowed, by the way, both still able to live independently, but not necessarily for much longer. Yes, but it puts families in difficult situations.
Sure.
Right. So in addition to figuring out, so I first set out to figure out, okay, how can I make my house pay for itself? So that if I do want to stay and enjoy that backyard that will, matured and nice trees and everything by then, when I'll have more time. I don't intend to fully retire, or at least not until I'm at least 70, but yeah, but when I'll have more time is when I'll want to be able to enjoy that house.
Sure.
Right.
Yeah.
So that's why I have a problem with the idea that I'll be forced out of it. That I'll have to go to a different neighborhood.
On the reverse mortgages, that's such a wonderful point. I had not thought about it at this level, is that as property taxes go up, as home insurance goes up, you have somebody who's lived in their home. My mom's been in the same home for since I was in kindergarten. So my mom's been in
21.
Just a few years ago.
My mom's been in the same home for 45 years, and she does not want to leave. But if her property taxes and insurance began to go up to the point where she could no longer afford it on her fixed income, then a reverse mortgage, give me the fancy acronym again.
Or home equity conversion mortgage.
Home equity conversion mortgage. So that's not necessarily like, for her to get that and go on a vacation, but it could certainly.
Okay. Well, she can.
She could.
She could. No, the use of the proceeds is completely unrestricted.
Right.
Now, you'll understand the government won't allow us to create ads showing a senior couple, sitting on a sailboat
On a cruise.
on the Mediterranean, right?
Getting a facelift.
The truth is, well,
we are in America, sir.
We are in America, and here's something else that's fascinating to me, okay, which is seniors today are not my mother and my mother-in-law are the tail end of the so-called silent generation.
Oh no, they're very youthful.
Right. Well, they were. I mean, so they marched, against the Vietnam War in the 60s and smoked and got married later than the generation before. Yes, sure.
Mm-hmm.
But
They would have been born around 1950, right?
no, my mother was born in 1940.
Yeah, baby boomer.
Pre-baby boomer. Pre-baby
okay.
boomer. I mean, so it depends a little bit on who you ask, but most academics in the Census Bureau will sort of agree. Yes.
It would be
It's Friday, my math is wrong.
Well, it's not an exact science,
Yeah.
but most people believe most will define the baby boom generation as people born from 1940 in the U.S. at least, born from 1946 through 1964.
Yeah.
An 18-year
Yeah.
period.
Yeah.
Then my Gen X, I'm part of that,
Me too.
whatever that really means.
Yeah.
We're 1965 through about 1980. Right?
Yeah,
Okay.
second generation. I'm
All right.
75.
Yeah.
So, but the baby boomers are now the seniors. So my mother's generation, right? They're the tail end. Those who are still alive.
Mm-hmm.
They're not so active in the real estate market anymore, except in those cases where they want to age in place, as we say, and stay in that house, right, or even that condo. In some cases, condos can be warrantable, secured by a mortgage, and they just don't want to move,
Mm-hmm.
or they don't have a family situation where they can just move in with a son or daughter,
Mm-hmm.
right? So there are many of those situations. The baby boomers today, though, here's the interesting part. So there were 76 million baby boomers, and until the millennials or their children overtook them just in the early 2000s in numbers, they were the largest American generation ever alive. Right?
They're still one of the largest holders of real estate today.
So
Equity.
not only that, yes, they own nearly half the equity. Very good point.
Yes.
So I
Yes,
pulled a few
yes.
numbers on that. So it's estimated there's about 35 trillion with a T, of home equity held in residential home equity held by Americans today, right? 14 trillion of that by itself, a mind-boggling number, bigger than the GDPs of all but 2 countries in the world. 14 trillion of that is held by seniors, 62 and above, right? So nearly half.
That's an incredible
Nearly half.
number.
So
yeah.
these seniors, the baby boomers are now the seniors. They might not like that label, but age-wise they are.
Sure.
Born in 1964 means that the youngest ones of them, I repeat, the youngest ones of them, turned 60 at the end of last year, at the end of 2024. So they're nearly all now eligible for those reverse mortgages, home equity conversion mortgages. The oldest ones, born in 1946, like Donald Trump, right? He wouldn't want to hear this, but they're turning 80 next year. They're starting to turn 80 next year. Okay, so they're all seniors for all practical purposes. They have more equity and higher expectations than any generation before.
I would agree with that.
Right. So some of them want age in place. Others, and this is where it gets interesting, and this is where the reverse mortgage business that I first went into for myself, to understand it for myself when I'll become old enough. Secondly, to diversify, away from just purchase mortgages, because it's, that's been tougher with these higher interest rates. But where I can actually help build my business with realtors and with builders is reverse purchase. Now, this is really not well known.
You can buy a new home doing this, correct?
Yes, you can.
That's a misnomer out there. Most people do not realize that.
Very few people realize that. The public basically doesn't know about reverse purchase.
Reverse
Many people-
purchase. Okay.
Reverse purchase, yes. It's the same home equity conversion mortgage, so it's the same FHA insured mortgage product. Okay, realtors and builders really want to think about, should be looking more further into this, because essentially, depending on how old the person is, or how old the youngest borrower is, if it's a married couple, but it often isn't. You know, many seniors are divorced, widowed. Gray or silver divorce is on the rise, by the way, the new generation.
Yeah.
For better or worse, right? We've got to look at those realities. That too drives the real estate market. Many of those buyers are single, so they unmarried is the legal term, which encompasses divorced, never married, and widowed, right? So there's only one age to worry about. Then the second variable is the starting interest rate, and the third, of course, is the home price. So, but anyway, to try to keep it simple, typically a person in their 60s, let's say, or early 70s, can put 60 to 65%, or about 2/3, but as little as 60%, if the rate is a little lower, down on a new house, and then never make a mortgage payment again. The balance is funded by the lender, and then it accrues, and then it gets paid off at maturity, which is when the property gets sold, or the borrower, or the last surviving borrower. So a surviving widow, let's say, like could be my mother or mother-in-law, is protected, is able to stay in the home even when she's down to one Social Security check each month, right? So that's very often, those are the situations we have. But what it means in practical terms, where it's exciting for us as a business opportunity, is this means that those qualifying seniors who, I really believe, if they're boomers, they don't want to downsize, or they may want to downsize in square footage. They don't want to downgrade their lifestyle.
Oh, absolutely, yeah.
This is not my grandparents' generation.
No, they're very active.
They're very
Yeah.
active.
They have a lifestyle.
They've lived in a developed country in an age of affluence pretty much their entire life.
Yeah.
At least compared to the Great Depression, World War II, whatever came before. So they have high expectations, right? So in practical terms, this means a 70-year-old couple for who it's time to get to say goodbye to that too big house, that 2-story house. We can help them find the 1-story home that fits their needs, but that's not a downgrade, and we can present them with the option of putting only $300,000 down on a $500,000 home. That can be a real listings maker. That can be a tool to generate 2 back-to-back transactions for people who are otherwise hesitating, who felt they couldn't afford to they couldn't downsize because they were rate locked in.
And they get the senior exemption. They freeze their taxes.
Yes.
There's a lot of good stuff.
Absolutely. Now,
What's the minimum qualifying age for this? 62?
62.
62.
For the home equity conversion mortgage. Now, there are some proprietary reverse mortgage programs that are not HECMs, that are not FHA insured, from Finance of America Reverse, let's say, or other lenders, where you can qualify as young as 55.
And so it's a similar program, but with different requirements?
Yes.
Because it's a different package.
More case by case, and often,
Yeah.
often those are more aimed at for higher loan amounts, right? For bigger homes, right? For
Different risk factors.
Condos, let's say, can be used there. But often, now I want to add something else. Part of the myths and misconceptions, or part of the bad image of reverse mortgages, is that just a loan of last resort. You know, the poor old widow who otherwise is getting forced out, is being evicted basically by her property taxes and insurance. And those cases do exist, right? For sure, right? As we know. But you'd be surprised how affluent some users of both the reverse mortgage and reverse repurchase are.
Because they're leveraging.
Well, they're leveraging what we call now. Can I use a quick visual aid here?
Sure.
Just one or two.
Yeah,
Okay.
of course.
Yeah, not a ton, but you know. Okay. This is where asset management or financial planning and real estate.
Which we are not financial planners.
No, but I was.
Oh, were you?
I was licensed. I had that license for many years, right? So I can talk about this. Okay, so essentially, bucket one is our income, right? From any source, right? So typically from the ages of, from when we're about 18 to 62, everything first comes into bucket one, and then from there we gradually fill buckets 2, which is financial assets, bucket 3, which is home equity, right? Okay, that's our pre-retirement wallet at the top, right? Flows from 1 to 2 and 1 to 3, and we try to build both of those up.
Sure.
After we retire, and of course, as most of us know, it's getting harder and harder to work until your full retirement age for Social Security.
What is full retirement age now for Social Security?
Right here. So
Depends on your age.
depends on your age. Okay, well,
Missy.
Is it
Okay.
50?
No, no.
Okay.
Only if you become disabled. So Social Security isn't also a disability and survivors program.
Yes, I do know that. Yeah.
Social Security retirement eligibility also begins at age 62, and so the HECM program sought to align itself with that.
Sure.
Right? So 62 is the minimum age at which you can claim retirement benefits. Full retirement age for anyone born after 1960 is 67. It used to be 65 for those born in 1955, and then added a few months added for each year between 1956 and 1960. For anyone born in 1960 or later, so that's all the present company, right? It's 67.
Right.
Okay. Now here is where it gets tragic. Okay, this is Social Security. All right. This is a snapshot. This is Social Security in 2023. Okay, so on this side, all right, here's what happens when if you're a typical worker, let's say, right, nothing fancy, you drove a truck, you taught school, whatever it was.
It's an average person.
Middle
Yeah,
school, middle class.
A typical middle class American who's in line to receive a $2,000 a month benefit starting at his or her full retirement age. Okay, if you claim,
And that's about the average for most people out there.
probably so. The
That's
maximum is only about 4,700, and that's if you've contributed at the highest levels for many years.
Sure.
And not that many people are getting that. So
That still isn't a lot of money in today's day.
55,
Of course
60
not.
a year. That's what it comes down to.
or if
If you're at
that,
2,000 a month, that's 24.
Right,
24,000,
but the
right.
four something is.
$24,000 a year for me would barely cover my property taxes and insurance by the time I'm
I have so much.
62 plus.
Yeah.
Right. So
Right.
so but here's what but even that is a little bit of an ideal scenario, right, compared to the reality today. Here's the reality. If you claim at 62, that $2,000 a month is marked down, is reduced to $1,400, 30% off, 30% less, and it's reduced permanently for the rest of your life. You'll still get the COLAs, the cost of living adjustments. You can never go back and say, oh, sorry, changed my mind. I just inherited, I want to stop and I want to come back when I'm 67. Nope, can't do it.
Yeah.
Can't do it. Once you're locked in, starting 62,
So everybody's
That's
waiting
it.
as long as they can to get a bigger check.
Right.
no, they're not.
Oh, they're not.
That's what they should. That's what I plan to do. So I plan to keep working at least part time. Wait till I'm 70, right? So my full retirement age is 67, right? But if I wait till I'm 70, again in today's dollars, in today's terms or 2023 terms, and supposing that my full retirement age benefit would be $2,000. If I wait until I'm 70, I get 8% more per year after my full retirement age and up till 70. And so 8% compounded 3 times, that's about 25%.
Oh, it's 8% compounding each year.
Yes.
Oh,
So
that's huge.
I mean 8% more each year. So that's a quarter more. So if I can wait till 70,
Wow.
again, supposing I was retiring in
But that's a
2023.
55% swing difference for 7 years.
Yeah, yeah.
55%.
8 years. Yes.
For eight years, I'm sorry.
Yes. But so 2,400, so 2,480, nearly a quarter more for life if I wait till I'm 70. Now, of course,
You got to have the health too.
I got to have the health. I asked a financial wealth manager who's very active, who has many clients in this situation, who's better at this math than I am. Actually, you have to live to at least age 82 for that math to be in your favor. If you feel that you're not going to,
Oh.
then
I see.
claiming earlier can make sense.
So the matrix works multiple ways.
Right. But now,
Predicated upon.
right. But now here's what's actually happening. When do workers claim Social Security? Now, I don't expect this to be legible necessarily online, but happy to send a copy of this.
Yeah,
So this
reach out to
is
us.
from the AARP bulletin, right? It's not proprietary.
Yeah.
Happy to send this and this to anyone who contacts me and wants copies, right? So here's what actually happened in 2023, and 24 was about the same. 27% of Americans reaching age 62 filed for benefits right away. That's more than a quarter.
In 2023.
In 2023. So it's a few million people who reach that age that year. 53% filed between ages 63 to 66. 27 plus 53 is 80% total. For all practical purposes, in 2023, nearly all of these people were at least a few months short of their full retirement age. So nearly all of them left some money on the table.
Wow.
So even if you're just a few months short of full retirement, if you decide to go ahead and pull the trigger, you're not going to get the full retirement.
Right, that's right. So here's what makes the most sense.
Wow.
But many of these seniors, right, are sitting. So here's why they want to do that. Okay, they want to avoid touching their bucket two, which is financial savings. Supposing they have them. Of course, not everyone does.
Sure.
But even those who don't have much of a bucket two to tap into, they may have a bucket three. If 64% of American households are homeowners, let's say 65%, that rises to over 70% among seniors, right? There's obviously overlap between those groups, right?
There's
Some
lot
of those
pent-up equity sitting in
right.
each of them.
A lot of that pent-up equity is owned by those seniors whose income is dropping off in retirement, who are filing for those Social Security benefits as quickly as they could. A reverse mortgage, not for purchase, but on the home that they currently own and that they want to age in place in or that they want to stay in, can be a way to defer claiming Social Security for as long as possible. It can allow them to, even if they have substantial financial assets, again, bucket three should not be, tends to be seen as a sacred cow. You know, it's the real estate. You're gonna that's what you're going to die in a fully paid for house and leave it to your heirs,
Which they're going to fire sell anyways.
Exactly.
Typically.
Exactly. Very few. Yes, very few.
Yeah, Richard's had quite a few transactions.
Right.
I'm sure that were estate sales that.
My
They
job
were
is to get as
inherited.
much money as possible for the heirs, but it's amazing how many of you I just want to get rid of it. I don't want anything to do with it.
Yeah, they
Right.
just wanted
And
to.
all-
Yeah.
And I'm sure that you've witnessed, you know, all the heirlooms, all the silverware, the embroideries, the old books, and everything that my mother-in-law is clinging to
Mhm.
from your life
Oh,
that she
yeah.
got from her own grandparents. We're not going to use that.
Yeah.
We're not going to do anything. It's going to go.
What are you going to do with an
So-
encyclopedia set today, David?
Not much.
The kids today
Show
watch
it
this
to,
one.
show it to my
What?
Gen
This is
Z.
an encyclopedia.
Show it to my Gen Z children.
That was my Google as a kid.
I know. I grew up with a set.
Yeah.
My
No.
fourth grade teacher used
So-
to sell it door to door.
No, so exactly. So that house is not really going to is not going to be lived in by the children or the grandchildren for all practical purposes. Even from an estate planning perspective, or if you fear that you might die suddenly, right? Financial assets are always, I know this from having worked in that industry, they're nearly always much easier and faster to distribute to the heirs than a house, right? So Richard, if you get this call from an estate for an estate sale of a house, how long is it typically going to take for the house to be cleaned out, staged? So even supposing the probate, the will is clear and
Well, yeah, probate can take a year, 2 years.
Right.
And then once you get through all that, then you have an executor of the estate.
Right.
And then as far as make ready of the house, if there's anything that needs to be tended to, the clean out, staging, I mean, that's 1 to 2 months minimum. And then contract to close. You're
Right.
talking marketing, another 1, 2, 3 months. So you're still talking almost a half a year.
right. So probably
Of again, pent up equity or
Right.
monies,
Right.
just pending money sitting there.
pending money sitting there, but of course the property taxes and homeowners insurance,
Oh,
the
that
property
holding
has to
costs.
continue to be paid.
The holding costs.
that still has to be paid.
That's
Yeah.
chipping away at the value of the total value of the estate.
Right, and that goes back to day one because you have to pay for probate and all that.
Right.
All that time frame, it comes out. It's all
Right.
part of it, and you got to maintain it.
Right.
Yeah, just the little things, keeping the power on, making sure the landscaping's being taken care of.
And
All that
somebody
good
and
stuff.
somebody has and then so somebody has to be available. That's the
Exactly.
you know
Yeah.
in today's world. One of my neighbors in his 70s, and he's healthy, and God bless him, he'll be around a long time. But one of his children is in Maryland, another one, and the closest one lives in Austin, I think.
Mhm.
And they're all middle-aged with their own families and lives
Sure.
going on, and they're not gonna be available to just stop by and turn the lights off
Yeah.
every night.
And I think
you know?
that's why typically with the estate sales,
Yeah.
estates that have been inherited, the kids, whoever inherits,
It becomes a burden.
yeah,
Right.
normally they're just wanting to get the best.
So, right,
Quickly.
whereas the life insurance, the IRA account, for example,
Uh-huh.
okay, those can actually bypass the whole probate process. They don't even have to be part of a will. They're just the named beneficiaries, right? An IRA account, let's say, that's invested in liquid assets like stocks, bonds, mutual funds, right? The custodian of those assets needs a death certificate, a letter of instruction from the executor of the estate, and signature guaranteed by a bank that's over a certain amount.
Sure.
and the beneficiaries can receive their wires within a week. So,
Huge.
That's quick.
right. So this is why,
Yeah.
maybe if we need to wrap up, this is why I really want to urge the public, think about respecting moms and dads' wishes and understanding
Yeah.
one of them is likely to have to continue alone for a time. Let them age in place if that's their choice. Understand that using that bucket 3, should not be a taboo. It does not even necessarily reduce the value of the future estate. It's a choice also for families to just do what's right, and for the children and grandchildren, supposing they're there, is minimize the burden on themselves.
Well, and you're being proactive instead of being
Be
reactive.
proactive.
Absolutely.
Exactly. Be
Yeah.
proactive.
At least explore it.
Right.
Meet with David. Let him walk you through it. And if it makes sense, he'll tell you. If it doesn't make sense, you're going to share it with him as well.
Look at the options. Look at the options. A reverse mortgage basically is available, right, to anyone who has at least 50% equity, who is 62 or better, has at least 50% equity in a home that they occupy presently. To purchase a home, say with the proceeds from downsizing out of a bigger residence, typically you need it can be considered, again, if the person or the youngest future borrower is 62 or better, and if they have at least 60% of the price of the target, the new target property.
A tidbit: 50% of the homes in America today have either 100% or minimum 50%. So 50 to 100% of equity today, 50% of the homes in America today. So there's a lot of pending equity out there.
Yeah.
Oh, 100%. And again, nearly half of it is held by seniors, and that can be thought of as a silver lining. And maybe that's why more people are in Austin protesting right now, right outside the legislature meeting, is because they understand they're getting taxed more, but that's because the value of their property is going up. Well, I'm all about helping homeowners and families understand the different ways that equity can be monetized and used, and the options that it can give you. That's all.
If they want to reach out and connect with you for additional information, what is the best way for the audience to connect with you, David?
Well, so I'm here in the Houston area with Modern Mortgage First Choice. My phone number is 346-332-4580. Anyone can feel free to call or text me at that number anytime. Otherwise, David.Berenger, Berenger, at Motto Mortgage, altogether, so that's MOTTOMORTGAG.com. And that's it.
Awesome. Well, please reach out to David. We're going to have to bring you back on because I think we just scratched the surface of what you're truly trying to convey to people. So we'll go round 2 with you in the near future, David.
Well, I mean, a lot
I look forward to it.
a lot of these homeowners have spent so many years paying into their homes and getting all this equity, and now is there a chance, if they're in a bind right now, to be able to utilize that equity?
Right.
Yeah.
Or even if they're not. Just
But it also removes the cost of the sale, the move,
Yeah.
the closing costs, the down payment tab.
Maybe as one last note here, you can apply for and be approved for more easier approval than the purchase mortgages in most cases, by the way. You can be approved through a home equity conversion mortgage and just set it up as a HELOC that is available to you if and when you need it.
I'm so glad
That's
you
my
mentioned
personal
that.
plan.
I remember.
Is
what I plan to
that
do.
for up to 10 years? Is there a time frame on that?
For as long as you occupy the house. No, it's there.
Okay,
It grows.
so most of them are a 10-year program. That's
Well,
what I'm asking.
so it's a HELOC that offers extra protections versus a HELOC that you can get from a bank, let's say,
So
which is dangerous.
Again, we need to bring you back to cover more.
Yeah.
Yeah.
That is
Yeah.
such good
Yeah.
information because
That's my plan.
I remember you saying that,
To have that.
in one of the classes that you taught that I
Yes.
attended previously, is that you can have it in place. You don't have to use it,
Right.
but you can
Right.
have it in place
Yeah.
in case something does happen
Right.
and you need to quickly access.
That's my game plan on whichever house I once I become old enough. That's my game plan, to have that in place to draw on if needed and to not have to rearrange
It's
my.
easier to have it in place when you don't need it, because the moment you need it,
Correct.
then it's a challenge to get access to money.
Yeah.
Yes.
It
Yes.
just is.
It is.
Yeah.
It is. So.
Well, we went over this time, guys. Thank you very much for watching, supporting our channel. Missy, great job today. Thank you so much for joining our team.
Thank you. And thank you, David, for coming and
You're
sharing
so
all your
welcome.
wealth of
Yes.
information.
Thank you.
Next week, we will have Jess Johns Green on, who she is incredible yoga master, just such great information on mental health as well. And so we're gonna just explore some different
Awesome.
relaxation and stretching techniques. So hope y'all tune in next Friday at 11.
When you said we, I hope you're talking about you and Jess.
No.
Nope. We'll see you next week, guys.
Bye, guys.